Good morning, ladies and gentlemen, and welcome to the SHANTA Gold Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Eric Zurin. Good morning, sir.
Good morning. Thanks, everyone, for joining today. We're going to cover the Q3 results that Shanta announced this morning from our assets in East Africa. And just to remind you, Shanta is Tanzania's third largest gold company. We've been in Tanzania for 20 years. And today we announced a combined production of 27,935 ounces. So a run rate of 115,000 ounces of gold per annum. That's a run rate number if you annualize it, which is all pretty encouraging for us. So I should say that's the run rate over the last 6 months, not the latest quarter. So we're really encouraged by what we're up to. I was in Tanzania last week. I was there the week before that. I'm headed back in 10 days' time to Tanzania and Kenya. It's all very exciting. Lots of great things happening. We were with the president, in fact, last Sunday night at a dinner, Minister of Mines, Minister of Finance. Lots of encouragement. We're in the local news. Things are going particularly well for Shanta. So I'm happy to take you through some more detail. We'll answer questions. I won't cherry pick. I'll answer all posed questions and give you an open forum to speak to me. So without further ado, I'll take off the microphone or off the camera, and we'll go on to the slides. So just on to slide 2 of the presentation, where we cover a little bit about Shanta, and I'll reintroduce Shanta for everyone, for all the listeners, just in case someone's not so familiar with it. As I said already, we've been operating in Tanzania for over 20 years. The country's only been independent for about 60. So about a third of the country's entire independence post British colonial rule has included Shanta in some form. So it's really exciting. We know the place really well. I've been going there for about 10 years. We're capitalized at just over 100 million pounds. We generate, on the latest set of numbers, about $70 million of EBITDA. We're profitable. We're investing in our assets. We trade on just over 5 times earnings. We pay a dividend. We have 4 million ounces in the ground. We're very safe. We don't have any issues. Never had a fatality. We have 2 lovely and fully invested gold mines and processing centers. And we have a great platform in East Africa. I mean, we're just one of those AIM companies that is delivering, that is self-sufficient, and there's a real opportunity. So today our balance sheet is in great shape, $5 million of net debt. I was getting questions this morning from people saying, well, I thought it would have been 2 million. I thought it would have been 3 or 0. Take a step back, look at the big picture. The debt is going down. The production is going up. The cash flows are strong. And we have 4 million ounces in the ground. Like this is a real company that's generating a lot of cash flow. Don't get caught in the minutia of the detail, because the bigger picture is really exciting. So that's the message I'm going to leave with you. We're producing at a rate of 100,000 ounces a year of gold. Group all-in sustaining costs of $1,160, and our market cap's 100 million pounds. Can't think you can find me another one of these companies around. It's pretty rare. If we were listed in Canada, maybe we'd be 2, 3, 4 times the valuation we're at today. I don't know, but we're certainly attractive, and things are going well. We're well positioned as an unhedged gold producer. We generate attractive cash flows. Gold's in demand for probably the wrong reasons, but it is what it is. Gold is in demand right now, and we're feeding that demand. Our model is very specific. We're a decentralized company. We have myself and two or three other people outside of the country. Otherwise, we have 1,400 people, employees and contractors at our sites. So we are completely decentralized, and we have a huge bias. My big strong bias is to local content and indigenization. So the opportunity today, I mentioned this on a call about an hour ago, is that the UK market is not rewarding great companies like Shanta. There's a disconnect between value and price. The spot gold priced in British pounds is at an all-time high, and the market is not rewarding Shanta. It's as simple as that. Often in life, things are less complicated than what people perceive or appear to make them believe. We often take the simplest things in life and make a whole world around them. The reality is Shanta is a very simple, uncomplicated story. We produce gold, we generate a lot of cash, and we're attractive. So on to slides 2 and 3. We'll go through some of the quarterly performance and touch base on some of these numbers. So during the quarter, we produced 27,935 ounces of gold, up a staggering 82% from where we produced in Q1 before Singita came online. Over the past 6 months, since Singita started production, we've produced 57,338 ounces of gold. That's how I get to my 115 run rate. That's before we consider expanding Singita. So we're on a very good trajectory. Now, EBITDA during the quarter was $19 million. And over the last 6 months, if you annualize that, that's 42 million over 6 months, 85 million annualized. This is all since the inflection point when Singita went into production. As you would expect, what are we doing with that cash flow? Well, we're investing in our assets. We're drilling. We're spending money on exploration because that's our job, is to make these assets more valuable than what they are today. We had to complete some of the capital work at Singita. We paid for about $3 million for a generator, power station refurbishment at New Luica. We've paid a dividend. We've paid back debt. We've serviced interest. We've paid tax. And so the company's in great shape. Liquidity today is $17 million. When you add in our undrawn working capital facility of another 10, that gets us $27 million of liquidity. So I'll say it again. I said it last call. We will not be raising equity. So please don't ask that question at the end of the call. During the quarter, we achieved attractive cost levels at New Luica. So this is our 6,000 ounce per month asset in southwestern Tanzania. And the costs were better than expected at Singita. This is the newest mine. So over at New Luica, the operating costs were $970 an ounce and all-in sustaining $1,279 per ounce. So it's firmly in our guidance range of $1,200 to $1,300 an ounce. And the costs were up slightly from Q2, but that was a record period. So again, as I said, we've already invested more in sustaining capital this quarter, which increased the all-in sustaining cost a little bit. Now, there's two reasons to think about all-in sustaining costs. One is the company are the costs at the right level? The other is, are the costs being predicted? So what you don't want to see is a company set guidance and then 3, 6, 9 months later they have to start changing it because they're not really on top of their costs. So in January we set guidance of $1,200 to $1,300 an ounce. I think year to date the number is I think it's just sub 1,200. So it's for the group, and it's in the 1,200 to 1,300 for New Luica. So we can predict we can set a sense of reliability and confidence in our plans. That's important. Now at Singita, operating costs and all-in sustaining are $713 and $899 per ounce respectively. These are way better than what we thought. But remember, Singita is a brand new mine. So these are 40 and 37% better than our plan and our budget. It was driven by strong gold production, So we've had better than expected grades, better than expected recoveries, lower than expected costs, and but the caveat is that Singita's only been operating for 6 months, and it's only been in commercial production for 4 months, but it really is shooting the lights out. So we'll monitor these actuals versus our forecasts over the next couple of quarters, and we'll get to a sustainable producing level for Singita. As I said, over the last couple of years, or the last 2 years really, the inflection point really for Shanta recently has been the transition of Singita from cost center to cash flow generator. So you basically, literally overnight, Singita stopped consuming cash and started returning cash, and that's a big plus. And when the gold price is $2,000 an ounce, that's pretty good. Safety across both assets is excellent. Year to date, we've had no LTIs and no recordable injuries. Touch wood. We've never had a fatality at Shanta Gold. On to slide 5, and a little bit more on how we're tracking versus our guidance, versus the scorecard we've set for the market. So headline full year production is 90 to 98,000 ounces of gold. Remember, that's only 9 months of contribution from Singita. And that's at a range of $1,200 to $1,300 per ounce. So what have we done so far? We've produced 73,000 ounces of gold in 9 months at an all-in sustaining cost of $1,160. So if you do the math, it's looking pretty good. Now, at New Luica, we've our cost structure is, as I said, firmly in place. We're $1,289 for the year so far, within the range. And production is tracking pretty well on target there for the 66 to 72,000 ounces. No reason to see why that would change in Q4. Kind of 3 weeks into October, it's kind of on track. Singita, it's we've got it for 24 to 26,000 ounces for the 9 months. So far, we've produced just shy of 20, so that's looking probably a bit better than expected. And the costs here, as you can see here, year to date, $816 versus a range of much higher. So Singita's well on track to do better than it expected. But remember, Singita is only a couple months old, so don't want to jump the gun. On to slide 6 and 7, and we'll look a little bit more at some of the details from the two assets and what did we do in the quarter. And then we'll talk a bit more about the exploration and what we're targeting. So on slide 6, we mined 244,000 tons of ore at New Luica, which is the best we've done in at least the last 2 years. And that's down to equipment, labor, the open pit contractors, the supply chain being reliable, everything kind of working well and in sync. There's been a lot of hard work, I can promise you, since the pandemic to get to this point, to get the operations back on even keel. And they're now working smoothly. And we have a motivated workforce that's aligned, and you can see it in the numbers. We milled tons of 226,000, which is just shy of the all-time record for a quarterly performance. So the processing plant is accepting and milling the tons that it receives. Recoveries were a bit lighter than expected, and at 86.5%. And we expect that to improve in Q1 2024 as we commission our pre-leach thickener, which we started construction on at the start of this year. So you can see here gold production's steady. It was really a nice steady quarter. If you annualize that 18,271, you basically get the top end of our guidance of 72,000 at New Luica. So, well on track there. And then, of course, the gold price, 1930. What does that tell you? It tells you we're totally exposed to the whole gold price. We're unhedged. That's the way we want it. Now, the final point I'll make on New Luica is that we produced around 6,000 ounces per month in each of the 3 months. I think there was only 1 month where it was just shy of 6,000, and 18,271 for the quarter. So why does it vary month to month? It's simply down to the mine plan and the sequence of where you are, typically underground. On to slide 7, over at Singita. Just to recap, first gold pour was on March 30th. We declared commercial production on June 1st. We constructed and self-funded Singita. We did the work ourselves. We were convinced it was going to be a great project. We got external quotes to build it of about 70 to 75 million, and we ended up doing it for just over 40. So what does that tell you? With the right people and the right plan, you can achieve great things. And so over at Singita during the quarter, we milled 93,000 tons, which is just a bit better than 1,000 tons per day, which is the stated plan and capacity. Grade and recoveries continued to do better than expected, and we'll look at that in a second. The Singita mine produced 9,664 ounces during the quarter. It's better than forecasts by about 15%. Production was stable. All 3 months achieved over 3,000 ounces of production. We've had positive reconciliation of ore grades versus the reserve grade. The mill throughput was steady. And as I said, the recoveries are 97.4%, which is much better than the original plan of 91. So we were mining at the Gold Tree and Vivian pits. Remember, Singita is a 100% open pit, an open pit operation in a greenstone deposit. It's a lovely little setting. I was there last week and can report things are calm, and the labor component is very motivated. The big question at Singita is when, hopefully not if, we'll be able to expand the plant, and that will come on the back of positive drilling results and reserve additions. On to slide 8, a little bit more about Singita's specific points from the plant. You can see here that we're being cautiously optimistic that the plant will do better than expected. But again, remember, we're only 4 months into commercial production. So on the left-hand side of this page was what we expected in our plans before we built Singita. And on the right-hand side is what we're actually achieving. And the 3 to look at is recoveries, gravity, and purity. So how much gold is there in each piece of rock in the bars. And they're all better than expected. So that's pretty encouraging. Generally speaking, we'll continue to follow this closely and see what we do with it in terms of our plans going forward, whether we upgrade them and when. On slide 9, 10, 11, and 12, just cover some exploration highlights I think are pretty interesting. Don't talk so much about exploration, but we'll try and cover it at least once a quarter, and then we'll have some RNSs out before the end of the year. So on slide 9, we look at a plan view of Singita. So this is the top part of the slide is looking down from the sky. And you can see the Vivian, Gem, and Gold Tree deposits. These are all within our mining licenses. We're mining at Gold Tree. We're about 20 meters down into the pit. And the hypothesis is that these are all connected. This is really just one big deposit, as opposed to what we're seeing, in the bottom half. This is the plan view. Sorry, the long section where you have 3 distinct deposits. Now, it could so be that these all connect and you'll end up having one big open pit. That needs to be proven through drilling, and that drilling is designed with 31 holes, totaling 5,670 meters. And so that's work that's ongoing. Call it the Singita Super Pit. That would be exciting. On to slide 10, and a bit more about what we've been up to over the last, really the balance of the start of the year to where we are today. Recall that Singita is an underexplored greenstone gold deposit, so that's a good starting point. It has this intensity about it, being a greenstone deposit. There's 7 deposits across a 5-kilometer strike. Could that be one deposit, one big open pit to be told, to be discovered? And so here on the top half of this slide, what we've done is we've shown some magnetics around the mining licenses, and we've looked at an analogy in the Abitibi Gold Belt. And Yuri he's pretty excited by Singita. A lot of similarities to places he's worked around the world, and we have a crew there now full time at Singita looking at the potential and how we focus this drilling. Now on the bottom half of the slide is really interesting here. So as Singita was the construction was completing and we were going into cash flow, we deliberately did not drill because it was just, in mining you want to do one thing at a time, not 10 things at a time, because typically things could go wrong if you're doing too much. And so what we did is we went back and looked at some of the old drill core, dating back. I think this core is 2014 was drilled. And for whatever reason, the previous exploration teams just didn't identify VG. This is visible gold in the core. And you can see it right across. So Corn Patch East, Gold Tree, Gem, Vivian, Kaiser, Gustav, right across the 7 deposits, 5 kilometer strike, you've got VG. And this isn't just minor VG. You have Corn Patch East, 320 grams per ton. So what is this? What's the point? Why am I showing this? Well, the reality here is that there's prospectivity across Singita, and it's underexplored. It's not well understood. That's the opportunity at Singita, is the fact that you have a producing mine, you have all the infrastructure invested, and you have this lovely underexplored greenstone deposit. So there's lots to do, and there's lots to look forward to. On to slide 11 and then 12. 11 being in New Luika, 12 being West Kenya. New Luika, the drilling's been a little bit slower than expected, unfortunately, because of the contractor. And so we've just, in fact, I think it was over the weekend, we've contracted a second drilling contractor who's already in country and who will be picking up some of the available meters. And so that I think they'll be starting possibly end of this week, just mobilizing the rig from Mwanza, which is great news, and we'll have some catch up. And here at New Luika, what we can see is one of the key target areas for us is the extension at depth of the Luika underground. And this is all pretty much underway to be tested. We're drilling small amounts, but it is coming along, and we'll have an update out on the results hopefully before the end of the year. At West Kenya, focus really is we have 2 active rigs, and the focus here has been at Ramula, where we're both drilling for exploration growth, but also infill. Why are we drilling for infill? This is the green areas, and trying to capture more of the area within the yellow outline. We're drilling for infill because we want to increase the mineable resource that will ultimately be in the economic studies. So that's important. That work's ongoing. As I said on an earlier call, I think we have a draft RNS, or about to have one completed, and we'll try and get that out very soon in terms of drilling results at West Kenya. Expected news flow, as I said already, today we'll have West Kenya drilling results out soon. We updated obviously our Q3 performance today. Some more drilling at New Luika and Singita before the end of the year. We'll pay our dividend. We've now we're on the docket for the TRA, Tanzania Revenue Appeals Board hearing. So that happens. There's two sittings in the next week or so, and then another one in November 10th, I think it is. And then that will be go through the deliberation process. So that's on their $23 million VAT refund. So we'll have to be patient with that. They tell us up to say 12 months to wait. But anyway, it's underway, which is great news. And then of course in January we'll have our Q4 results, full year update, and see how our production costs compare to what we've guided for. So lots to look forward to. I really want to thank everyone for being supportive of Shanta. It really is. I met with the shareholders maybe about 2 weeks ago. Many of the institutional shareholders, they continue to tell me Shanta's the standout on AIM. It really is, generating all this cash flow, trading at these very attractive valuation multiples, and kind of returning capital as well. So thanks for the support. Lots to look forward to. With that, I'll open up for any questions.
Eric, That's great, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while Eric takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Eric, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But Eric, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Okay, great. Well, thanks everyone for posing the questions. Let's go through them. Peter's asked, is it reasonable? So is it reasonable to expect the company to have net cash in Q4 or early Q1 next year? I think it's reasonable, but all sorts of things could happen. The gold price could have, or so I don't know, but it certainly seems reasonable to sort of think about that kind of trajectory. We then had a question from Alex, who's asked, can you please comment on the rumors about issues with the communities and leadership in West Kenya? I certainly can. And what I'll say is that during the quarter, we expanded our community engagement team. We expanded our stakeholder engagement plan as part of our feasibility study ESHA work. So this is the socialization work stream. And discussions are ongoing. Sensitization continues with all levels of community and government, because what we're socializing is a potential mining operation at West Kenya. Now, the question posed today is, can I comment on, you referred to them as issues. What I'd say is the following. Mining is new to Kenya. It's not like Tanzania. It's a newer jurisdiction. That being said, the Kenyans and the communities and government want to understand the benefits of mining, which they're not familiar with because it's new. And so you're always going to have certain individuals who see this as an opportunity to be a bit more vocal. But the resounding, overwhelming feedback we've had is that the Kenyans, government communities, want to see a mine as fast as possible because they want to see the benefits accrue. And what kind of benefits are they talking about? Employment, service levies, taxes, skills, bank accounts for themselves. Many of these people have never had a bank account. Healthcare. They want to be employed so they can get a healthcare package. They want local services, like they want to be able to have local procurement. This is the reality of these mining projects. Like Shanta's, the raison d'etre for Shanta is not to produce gold. The reason we exist, our whole purpose, is to improve the lives of the communities in which we operate. And if we get that right, the gold will come. But it is all about getting the benefits into the hands or the lives of the people that are impacted. And so that's a bit of background there. Can you tell us something about the protests at Ramula? What is Shanta doing to address the concerns of communities? Well, I just told you. The reality is we are sharing the benefits of what we're doing in mining, and the overwhelming majority is supportive. And this is exactly what we expected. You have certain people who see this as an opportunity to try and catch the limelight. But the reality is the overwhelming majority want us to go faster and do things quicker to get to a mining operation. So that's what we're doing. Gareth has asked, Shanta is de-gearing rapidly and moving into a highly cash generative phase, supported by tailwind of the gold price. Is there any consideration of increasing the dividend payout? It's a good question. A lot of feedback I've had recently is around doing a share buyback, actually. I'm not saying we'll do either. I can't speak on behalf of the board. I'm just telling you what the feedback I've gotten. But I must remind you, at the start of October, the gold price was closer to $1,800 an ounce than it was where it is today, 3 weeks later, closer to $2,000 an ounce. And so in mining, particularly when you're like, you take our philosophy of being unhedged, you're totally exposed to the gold price, which swings around, 10, 15%, which makes planning very, very challenging, because you have to sort of plan with a conservative air to your assumptions, because you just don't know what your selling price will ultimately be. Now, obviously, there's been all sorts of trouble around the world, lives lost, infrastructure destroyed, just really horrific situation, and nobody wants to see any of that, which is, it's really sad actually. But the reality is the gold price has reacted to it. Could be the gold price reacting to the high levels of debt and all sorts of geopolitical challenges around the world. So will we rush into increasing dividend payouts? I doubt it. Will we consider one-off events like possibly a share buyback or possibly a one-off dividend? Maybe. I mean, that's kind of the philosophy of Shanta, is to be relatively in tune with a conservative approach, and then to top up when we have the ability and the resilience to do so. Sorry for the long-winded answer. Ryan's asked, how much cash was used in exploration? Is there a timing in the levelish cash for the quarter stockpile of product timing? I know some debt was also paid, but thought cash would be up a little bit more. This goes back to my earlier comment around, I guess, the peculiar the detail around these quarterly performance appraisals we do, these Q3 reports, these quarterly reports. At the end of any one quarter, we might have locked up gold of 3, 4, 5,000 ounces. So you might not see it in the cash, but we include it in our net debt. You might have a quarter where we've had to invest $3 million in a power station refurbishment as planned. But that only happens every 2 or 3 years. And so you get this lumpiness around the balance sheet, which kind of moves, swings, and ebbs and flows. And unfortunately, for the market, it's not linear. And so when we're doing things like, say, drilling or stay in business capital or completing capital from another project like Singita, or making tax payments, or reinvesting or paying a dividend, there's a little bit of seasonality to these things. Mantas has asked, hello, Eric, if the decision is made to double Singita production, how long would it take to do so? To actually put the infrastructure in place, I think is 8 to 10 months, roughly. We've done it before at New Luica, where we've installed another mill. So I think we could do it reasonably efficiently. But we're only going to do that once we know the reserves are in place. And that's probably not until Q2 next year at the earliest. There's another question here from Kenya. There was an article in Kenya about from one of the governors of the provinces wanting Shanta to leave. Again, I would reiterate, we're socializing a potential mining operation, and the communities want to understand the benefits. And we've been sharing those benefits with these individuals and communities as we expand our engagement plans. So nothing to worry about. As you could expect, if you were a politician, you'd probably want to see a significant project, because that'll bring jobs, taxes, employment, improvement in livelihood, and sustainability projects. Raymond has asked a question about Lombard Odier, 6.7% shown on your PowerPoint. Could you clarify why it hasn't been RNS'd and updated on the Shanta website in the AIM 27 section? Well, we've included it in our presentation. We're not responsible for individuals, institutions to make their own declarations. But what we can do is we do a quarterly shareholder update. We do that through a company called a service provider called Equinity, and then we update our shareholder register. I thought it would have been updated on the website, but if it isn't, we'll definitely get to that today. So apologies, Raymond. Camille has asked, hi, Eric. Firstly, I'm glad you're still with us. Hope you will stay to manage Shanta for many more years to come. Thank you, Camille. Regarding the future of the West Kenya project, what are the biggest risks? Can we get support from local community as good as the operation in Tanzania? Now, I see a theme here. This is, I think, the fourth question on this one. The short answer is yes, there will be significant benefits to the communities and the local and national governments. And that's what we're doing now, is we're sharing those plans and that education process. The biggest risk, I would think, around West Kenya is not social. I always think of the risk of going from an exploration project to a construction and producing asset. That's the biggest risk. It's operational, I think. Because if the economics are great, the case can be made to communities of why you want to have a mining operation or some sort of infrastructure. And there's huge benefits, which is, again, goes back to how we socialize. And remember, we've been doing this very successfully in Tanzania for a long time. And we're our playbook, we're confident we can roll out in Kenya and be successful there as well. Nigel has said, Jumbo, Eric, Swahili. Thanks, Nigel. So if the market cap might be significantly greater in, say, Canada, why not have a listing on such market as Asante Sana? I take that with a grain of salt, pinch of salt. It's quite easy to always say the grass is always green. And I know I said that. I know I did say that earlier in this call. The reality is I think that the trouble is around the junior market space. When you look at how junior mining companies have been derated around the world, really, I don't think it's as easy as just listing somewhere else, unfortunately, because then you have this challenge of creating liquidity in two markets, and it's just not that easy. So our job here is to deliver results for the shareholders, to have a solid, robust, resilient, attractive set of assets, and ultimately to see value however it may come, whether that's through the market or some sort of clearing price or whatever it is. Ryan has asked, are you expecting dividend yields to increase much more significantly? This tends to impact the price of larger companies at the moment. It's interesting. I mean, when we put the dividend in place, I guess the Fed funds rate was negligible, 0.25%, whatever it was at the time. Today, the yields, treasury rates are much higher. So a company paying a dividend is simply not as attractive as it used to be on a relative basis. That being said, we're not going to change our plans. We'll continue to pay our dividend. We're yielding about 2% now. I think it's nice to have a dividend. I'm a shareholder. I like getting the dividend check. And so there's no plans to change the dividend. As I said earlier, if anything, we'd probably have a one-off to reward shareholders. What were the main factors behind the rise in costs? Peter's asked. So we've had a slightly higher cost at New Luika, but remember that was coming off of Q2, which was an absolute record breaker in terms of performance, in terms of production and costs. I mean, Q2 was outstanding at New Luika. So the costs were higher at this quarter, down to slightly less production. I think it was 1,500 ounces less. And we've had more investment into sustaining capital. So we have referred to this $3 million power station refurbishment as planned. And that goes straight into all-in sustaining. Raymond has said, are we still seeing share hangover from Odie? There's been constant gradual sell orders by MMs. I think that's market makers, which seems to be muting the share price. Are there other institutional investors selling too? Are initiatives in place to attract new shareholders to absorb these outstanding sells? I'll tell you this. What I can do, what I can control is the company's performance. So my job is to make sure that the company's producing gold safely. We're getting our story out efficiently to the market. We're communicating timely. We're doing all we can within our control. We're looking to encourage other investors to buy shares in Shanta. I can't control selling. Now, if an institutional or retail investor or whoever that might be has a reason to sell, as we saw the case with Odie, That's beyond my control. Now, what I can try and do is encourage a liquid market for shares to transact. But if there are institutions who need to sell, they need to sell. Now, the reality is with the AIM market, when you look at the bigger picture, there's been, I think it's now 25 months of continual outflows from the AIM market. I think the AIM market is down something like 50% year to date. I mean, it's carnage, on AIM. But the standouts like Shanta are really, really attractive. And but the reality is some institutions just have demands on their funds and redemptions, and it's tough for them. So I sympathize for them. But our job is to control what we can, which is performance and getting the story out. Mason has asked, there were some negative comments about delays in payment of compensations to locals in relation to Sangita. Could you please explain if there's an issue here? What's the cause of the delays? Yes. I think there were 3 or 4 people who were on the fringes of the mining license, where we might mine in 5 years. And so we've chatted to them about that. We've chatted to the mining authorities in Tanzania, and we have a plan to make sure that there's no detractors around. So there's always one, but nothing to worry about there. Raymond has asked, to absorb the outstanding selling from institutional investors, would share buybacks be considered a better use of capital allocation than dividends until we get back to fair value? Yeah, why not? Good suggestion. I've heard that from some of our institutional shareholders. They're encouraging share buybacks. Really, it's down to what the board wants to do. The board might take a view that it's better to invest in our own assets and let the market correct itself. We'll see. It's beyond me, and it's really for the board to decide. Raymond's asked, what's your gold price prediction for the end of 23 and 24? Raymond, I mean, this is a tough one. I'm a gold bull. I'm long gold. I'm long Shanta. We're all in this together. I hope gold will go up a lot, but I hope it will go up for the right reasons, which is, I think, linked to debt and not war. I think war is never good for anyone. And anyone who kind of encourages war is probably not thinking straight. So I certainly hope the gold price will go up again, but I really think I hope it's because of fiat currencies kind of losing the bid. And you can see that with China. They're selling US assets, they're selling their portfolio of treasuries. There's really this de-globalization that's going on. And I think that's good for gold. But I don't want to see anyone get hurt. So hopefully the gold price will be 2,000, 2,100, maybe 2,500 if we're lucky. I would say it's correlated to the amount of debt that's in the world. So the more debt, the higher the gold price. And I think that's where we're headed. Ryan's asked, if the gold prices spiked to $2,500 as an example, why wouldn't you at least part hedge to guarantee fantastic profits? Well, I don't know the answer, but I might rhetorically say, well, what if we hedged at 2,500 and it went to 5,000? How would we feel then? It's a good point, and I'm not sure there's the right answer. All we can say from our perspective as Shanta is our strategy is to produce gold profitably and safely and to remain unhedged. And if someone like Ryan wants to lock in the profits at 2,500, then you are more than welcome to do so in your own portfolio, to buy to buy puts or sell calls as you so wish. But our job as a gold company is to remain exposed to the gold price. And there's some other reasons why. For instance, we're not in the business. We don't want to have margin calls. Those are quite disruptive if you get it wrong. It's also quite tax inefficient if you get it wrong. So if you, in Tanzania and in many countries around the world, if you sell gold at a loss, the government charges you tax on the highest price, not on the hedge price. So in effect, losses on hedging are not tax deductible, which compounds the problem. So for us, it's we like to keep the operation simple, focus on what matters, which is gold production and value, and not speculate. Michael H has said, you're doing a great job. In my opinion, the market is just an unpleasant place at the moment. Keep up the good work and the share price will rise when it's least expected. All the best. I could not agree more, Michael. Thank you for that vote of confidence. The market does correct itself when you least expect it, and just don't get caught short. Raymond has said, as you may know, there's been some negative PR coming from Kenya. I think this is a repeat of the previous questions. Please share your thoughts on what plans to tackle these issues. This is the 5th or 6th time someone's asked this. I'll just repeat myself briefly. We have expanded our engagement plans and engagement team. We're communicating the benefits. We're taking a very long-term perspective, and we're confident that we'll be successful because we have a playbook that has been successful in Tanzania that we're going to use, we are using in Kenya. Bobby's asked, can you give a bit more insight into the reasons for Singita's better than expected recovery rate, particularly in view of lower grade versus previous quarter? Do you foresee recoveries being maintained? I hope so, at 97%. I hope so, but the reality is, I think the reality is the gold grades will drop back to kind of normalized rates of 3 grams. I suspect recoveries will also trend lower. They'll fade, not down to 91%, but they'll probably fade to around 94, 95% is my guess. But the only way to know that is to wait, and so that's probably where we'll end up. Is my guess. Are you? Mason's asked, are you intending to continue with a progressive dividend? So our dividend today is it's fixed at 0.1 pence every 6 months. That's sort of what we've communicated and we've stuck with. I think we've done 5 or 6 dividend payments now, and so until further notice, that's probably the expectation. Raymond has said, congrats in capital letters on another excellent performance on delivering gold at very low all-in sustaining costs. Are these very low all-in sustaining cost figures reflective and sustainable to carry on to Q4 next year? Singita certainly looks pretty attractive. I mean, the guidance is much higher than the actuals, and I would hope that Singita will perform better than expected, but let's see. New Luika is performing on track, so we've guided for 1,200 to 1,300 all-in sustaining. I think we're at 1,289, I think, year to date, so in the range, and it's kind of on track. Now, remember, the all-in sustaining costs include royalties, and where you have high gold prices, perversely increases the all-in sustaining cost. So just bear that in mind. A couple more here. I do have another call at 11, but Andrew K has asked, is there any progress in acquiring the old Helios licenses that would push out the mine life? Spot on, Andrew. That case was cleared last week, and guess who the first group was into the Mining Commission's office, reigniting our application permits. So the answer is we're interested, and maybe we can find a way. Sam has said, sorry for focusing on the minutiae. Can you explain how 19 of EBITDA only gets to 4 million of net debt? Was there a further increase in receivables in the quarter? Good question. I don't have the numbers in front of me. We're doing the work, and I can kind of guide you to sort of what's in between EBITDA and free cash flow. Things like tax, CapEx, sustaining investment, exploration spend, obviously debt repayments, but that's part of free cash flow. Interest we've had to pay, but can't remember how much the interest was. 10% of 20 million divided by 4, so that's what, 500,000. So there's all sorts of these things. The working capital swings around a little bit as well, and then you get to this net debt number, change in net debt. What I can say is the working capital is totally normalized. When you talk about 30 days receivables and payables, we have a great relationship with our suppliers. The balance sheet is fully in control, and so we're not there at the end of the quarter trying to fine tune what we get to in terms of net debt. It just sort of is what it is. This is the downside of reporting quarterly, and that's just where we are. Anthony has said, I'm only going to take a few more. I do have to leave soon, but you have presented a very positive picture of Shanta, which is great. What downside risks are there for Shanta? Great question. I often get this question. The biggest risk for a gold producer is producing gold, bar none. Operational is your top risk, because if something goes wrong with supply chain, labor, equipment, power, water, geology, this impacts production. So production is your top risk. And then you have all these other, when we look at our own risk matrix around tenure of licenses, geopolitical, commodity price. I mean, there's a lot of risks, but community, license to operate, but production is by far the biggest, operational is the biggest risk. The gold recovery between New Luika and Singita is striking. Presumably it's a matter of geology and mine process configuration. Please elaborate. Well, yes, it is, it's a plus or minus, it's 10% different in recovery. A couple things. So Singita is a greenstone deposit. We recover 45% of our gold from gravity. So there's less competition in the tanks. The greenstones will always be better in terms of recoveries. The metallurgy is just better. The grades are better at Singita currently. And so you're going to get better recoveries. So hopefully that helps. James has said, great quarter, well done. Please, can you disclose who the drilling contractors are at New Luika now that an additional one has been taken on? Does having two contractors increase complexity and average cost given 2 times mobilization? So we have, I'm sure you won't be able to find this person, but it's a local group called Ostrich. It's just been Ostrich Drilling. It's just been mandated to come in as a second contractor. The first contractor has been very good to us over the years. He's just been, I think, a bit swamped with work. And so there's no trouble at all in having 2 contractors. In fact, we do the same thing with our open pit fleet. We have 2 mining contractors. It doesn't increase complexity because they're given very specific and discrete tasks. We don't pay for mobilization. We don't pay for standing time. And so this is all about getting the meters drilled. Okay, so Raymond said, what are the political risks and percentage possibility of obtaining mining licenses now versus before in West Kenya? Seems we're getting pushed back. So the percentage of getting our mining licenses hasn't changed. We're going to put a plan together in terms of the feasibility study, communicate the benefits, and then we'll apply for the licenses. So we're pretty confident in all that. As I said, the overwhelming majority, near unanimous, is that we want to have mining operation because it brings a lot of benefits. So that's what we're doing. Will you provide an update on your eventual replacement? Sure. It's exactly what we said in the RNS, which is that there's a short list of candidates. The board's deliberately taking the time to make sure they find the right replacement. Given how strong Shanta is, you don't want to have a disruptive transition. And an update will be provided in due course. Richard has asked, firstly, thank you for all you've done for Shanta. I wish you success in your future ventures. Do you have any more news on when a new CEO may be appointed? I just answered that question. Toby has asked, given the massive gulf between the forecasted all-in sustaining costs of Singita and the realized all-in sustaining cost, how realistic do the all-in sustaining forecast look for 2024? What's a more current reasonable expectation range for Singita all-in sustaining costs of 2024? Good question. Listen, the reality is 2023 benefited at Singita. Singita benefited in 2023 from the very high opening grades. So we produced more gold than we would do on a normalized basis at 3 grams per ton. So that being said, on a per unit basis, costs were lower than expected. I would expect the cost to normalize at Singita. And I think the all-in sustaining costs over the 5-year plan were around about 1,100 all-in sustaining. So we've just gone through some of the budgeting work for 2024. We had a big budgeting session about 2 weeks ago. And we're working through those costs now and those plans. And we'll give a more accurate version probably in January when we provide guidance. Patrick's asked, congratulations on your achievements. You should be immensely proud of your safety record over an extended period of time. Thank you very much, Patrick. I couldn't agree more in terms of safety. It is core. When I go to the operations, when I go underground, when I'm driving in the trucks, I want to know that my life is safe, and I see no reason why that should be different for any one of our 1,000 employees or 400 contractors. There's absolutely no excuse for poor safety. Do you include the cost of drilling, exploration, and all-in sustaining costs, or are they excluded? We follow the World Gold Council guidance for all-in sustaining costs, and I believe that includes on-mine exploration, but not greenfield exploration. We still have more questions, so I'm going to put a hard stop at 10:58. So I have 2 minutes to prepare for the next call. But can you say what your expectation of gold price will be in the next 5 years? I believe it'll be higher than where it is today. I cannot put a number on it. Toby said, if the gold price were to stay at 2,000 for the next 12 months or even go to 2,200, would this significantly increase the chance of a buyback or special dividend? It certainly would probably make the topic more relevant when the board meets. If we are if we don't have any debt and we have the ability and the resilience to do that kind of activity. Yes. Gold sales at Singita are somewhat below production. Any particular reason? It's just purely timing. You have to line up the aircraft locally. You have to get the government in to check the shipment, to take samples, to pay the export license. It's just timing. Sam has said, today you said that a drilling contract near the week has underperformed. I remember recently he said that one of the labs was slow processing results. Is this just bad luck? Or are we finding it difficult with contractors? I think it's bad luck, really. It's just one of these things. So nothing untoward. Michael B said, any news on takeover? Michael, I cannot answer those questions. Even if I did have something, I wouldn't answer it. If I didn't have something, I won't answer it. So you can trust me that you can trust that my position is a bit challenging to talk about M&A activity, whether there is any or whether there isn't. Nigel R has said, thank you very much, Eric. Great job. That's the last question. There were quite a few questions today. So thank you very much, everyone, for posing those questions. As always, I've answered all of the questions unequivocally. I have not cherry-picked. And when we have more news, I'll provide another update and maybe another IMC. It's always nice to catch up with the retail shareholders and give yourselves fair access to management. So thank you very much for that. Thank you to IMC for hosting. Back to you, operator.
Eric, thank you very much indeed for being so generous with your time then, addressing all of those questions that came in from investors. And of course, we'll publish all those responses out on the platform. But could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team with Shanta Gold Limited, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.